Hey, welcome back to the Road to Retirement. My name is Chris Anselmo. I'm here with Tony Marlette Jr. Other co-host is off, handling, unfortunately, some tough stuff with his mom's going on. So we'll miss Tony Shore today. But Tony, I think you got a good program for us today. So
Yeah, for sure. We had talked about some mistakes that our clients make and how we correct them. So obviously this isn't to pick on anybody, but these are things that sometimes people do. Sometimes we can fix them, frankly, and sometimes it's a little too late. So to your point, we'll talk about some of these things, and we miss Tony today for sure. So. Uh, but if we get started on some of these things again that our clients do that sometimes we can fix and sometimes we can't. I call it letting the noise win. And the noise really can be anything. I
right.
think a lot of times people's minds get clouded with, I'm on X side of the aisle politically, and I don't like the current administration, so I'm just not going to invest my money because I don't trust these people.
Yeah,
We hear that. I've heard that on both sides, really. I mean, in my 7-8 years as an advisor, Chris, you've been doing this longer than I have. It spans three different presidential administrations. It's really on both sides.
yeah, you got to take the politics out of it because otherwise. You're going to be missing opportunities. I mean, the market has done extremely well over the last 20 years. And if you're just sitting on the sideline because you don't like who's ever in office, like they don't even know you exist. So it's like
Yeah,
not being in the market to prove a point to them. You're
it's
not
not
proving
going
a
to
point
work.
because
Nope.
they don't know, Tony Marlette didn't buy any stock today.
Right.
So
And
um,
honestly, they probably don't care.
yeah, they don't care
I mean, they
as
really
long
don't.
as
They
they're
don't
buying the
care.
stock and the
Right.
options, right? So,
Right.
yeah, get politics out of the way. Like once in a while, we talk politics with clients, but you try not to because you never know what side of the aisle you're on, and it doesn't really matter. Like you said, no matter what side of the aisle you're on, they don't really care about us. So,
Right.
um,
Well, I mean, you're going to have sometimes markets and finance and things collide with current events and news that's going on. Sometimes it's positive, depending on where you're at. Sometimes it's going to be negative. You
right,
you can there's enough negativity going on where you don't need to start letting it affect your finances and your ability to retire. We've had people say, I don't like such and such. I don't trust such and such. I'm pulling my money out. Well,
right,
such and such, like you said, doesn't care. And it
and
doesn't matter. It doesn't even affect them.
and they're not really running the market, right? So the presidents,
Correct.
who I mean, Congress, Treasury, whatever, they're not really running the market. So if you our theory always is invest in quality companies. So if you invest in quality companies, then everything should be okay, right? Because if those companies aren't doing well, nobody's doing well. So we want to make sure we're just doing a good job investing in quality companies, dividend paying companies, the Coca-Colas of the worlds, the Googles, the Amazons, the IBMs, those type of companies. But we'll talk about it a little later, there comes a point where you really want some professional management because you can't, not that you can't do it yourself, but you're too busy with your own life to watch this every day like professionals do. So what else you got there? We had
So we literally
uh,
ran a seminar on this one not long ago. Not necessarily the mistake portion of it, but your options with your 401k or your IRA. So, different things that people do with their retirement accounts because they're not informed of the options.
Yeah, the ones I think we see the mistakes the most, just because you're not informed, is when there's rollovers and transfers. Um, there, and one because the rules are not uniform. Spouses have different rules than non-spouses, and 401ks have different rules than IRA. I mean, it's ridiculous that they're not. Look, they're all some form of retirement plan. Why aren't all the rules the same? Some you can
Right.
take money out when you're 50, some at 55, some at 59 and a half. So I mean, it's not their fault necessarily that they make these mistakes. The only maybe fault is they didn't ask a professional. So some of the big ones, the biggest one I think is when you're rolling money out of a 401k into your IRA. Some people have them send them the check. So then what happens is you have $100,000 in your 401k plan, and they send you a check for 80, and you're like, I had 100. Where's the other 20? Well, people don't know that the tax laws require your employer to withhold 20% of the tax of that account if they send it directly to you. If they send it directly to, like if your account's at Vanguard and they send it over to Fidelity, they don't have to withhold that 20%. But when they send it to you, they have to withhold the 20%.
Well, it's how it's made payable. If they send
Right.
it to you and it's made payable to
Correct.
Ameritrade or Brookside or whoever it is,
Exactly.
then it can be made out, or it can be sent to you. It's just got to
Right.
be made out properly. And that's
Right.
what you need to know. I've seen people make that mistake a lot
Yeah.
where I just had the check sent to me, and then the mess that they find themselves in is they have to make up the taxes out of their own pocket unless, to basically correct it.
So if they have it, so Tony's saying, so let's say in our example, there was $100,000 in the account and you told them to just send the check payable to Chris Anselmo and I'm going to put it in my account and then I'll right. So if I do that, then I'm not saying, let me back up. I'm not saying our clients make checks to me. Okay. So you roll over your account, they send you 80,000 of it and they send $20,000 to the IRS. So if it's a rollover, you want to roll over the whole 100. So if you don't roll over the whole 100, then you're going to get taxed on the 20, which is kind of funny. You're going to get taxed on the 20 that they sent to the IRS. So if you don't have another 20 laying on the sideline to make your whole, you're going to get taxed on the 20. You're most likely going to get a refund because the tax on 20,000 isn't going to be the whole 20,000. So I think the bigger mistakes that we see is when people inherit money from IRAs or 401ks. So, Tony, let's say, I give my example. Say my dad had passed away. So if my mom inherits his IRA money, it's easy. She could either transfer it to her own IRA. She could leave it in his own IRA because she's a spouse. She has different rules. If you're not a spouse, which is ridiculous. These rules are just ridiculous. So if you're not a spouse, let's say he was going to leave it to me, my brother, my sister. So if we take the money out and have it paid to us, it's immediately taxable, 100%. We don't have 60-day rollover rule. We don't have anything. We have to pay tax on 100% of it. We can't just undo it. So those transfers have to be what we call custodian to custodian, trustee to trustee. So if my dad's account's at TD Ameritrade, I either have to open another TD Ameritrade account and have them send it to TD Ameritrade or Vanguard, but it can't go to me. So we've had this happen, unfortunately, several times from clients who don't know this. Who would know that? I mean, who? So let's just say the rules are just ridiculous. I mean, if it's coming from your own IRA, you have a 60-day rollover rule. If the spouse has a 60-day rollover, a non-spouse doesn't have a 60-day rollover. So these things, they sound egregious, but what happens is, sometimes people don't have the money to pay the tax. So they don't realize this. They take out the $100,000 from dad and they invested it somewhere. Actually, I've had some put it in their own IRA. They made the mistake. You can't put it in your own IRA. You have to keep it separate. But anyhow, so
you have to take withdrawals from it. You usually have to have it withdrawn within 10 years.
Yeah. So the new rules, you have to have it out within 10 years. But, in the situation we had for this one client, it was a $40,000 bill she owed the IRS. It's like, what? Well, you didn't do it the right way. Well, my advisor didn't tell me that at one end. Well, he doesn't do your taxes. So I think it was with Merrill Lynch, no names. I mean, we called them and we said, look, how come you sent them the money? And they said, send me the money. I mean, who are we to question if they said send me money, and they're like, well, we don't do their taxes. And we don't give tax advice. So if they send us the money, we'll send them the money. So
that's a nice segue into our next one that we see. Next mistake that people make is missing out on low taxes. We've been talking about this for a while now where, the Tax Cuts and Jobs Act from, I believe it was 2017 that was put into effect.
Mhm.
That's set to sunset 2024 or 2025.
25. Yeah.
I don't think there's any doubt. You've been doing in the tax business for a long time as an accountant, CPA. there's no doubt. I don't think anybody doubts that tax rates have nowhere to go but up. So it benefits people to take advantage of that
Right.
now.
So I, I'll date myself, but I've been doing this. So I got out of accounting school, John Carroll, in '84. I mean, I'm old, right? We've never had taxes this low. I mean, it's almost 40 years. We've never had tax rates this low. So the downside is it's just hard to write that check. I mean, logically, it says, look, we should be taking advantage of the 10%, 12%, 20% tax brackets, even the 22% tax brackets. But, when you tell someone to take $100,000 out and I want you to write a check for $25,000 to the IRS and, so much
what
more to the
you're
state.
referring to is taking money out of, say, qualified money, aka 401k or IRA right now, pay the taxes on it when the brackets are lower, and then this way when you go to withdraw the rest of the money, say 2025, 26 or later, you don't have to pay taxes
Right.
because you've already met your tax burden during the lower tax
Right.
period.
So if we convert it to, we've talked about this other shows, if we convert it to a Roth IRA, the benefit of the Roth IRA is you front load the tax. So you pay all the tax up front, and then their deal with you when they made these rules, well, if you pay the tax up front, we're never going to tax you again. But again, it's still hard to write that check.
We were just
like, you
talking
want me to
about
give
that earlier.
$30,000 to the
Right.
government? Like,
we make, I mean, there are recommendations that we make for certain clients that'll say, hey, you need to convert this Roth. You have $1 million. Congratulations, you did a great job of saving. Unfortunately,
a third of it's the IRS's.
right, you have about realistically, you probably have about 600, 650 in there.
Yeah.
And that,
Because we got, here we got to pay Ohio too.
right.
So,
Yeah.
so it's difficult so maybe one of the solutions is do a little bit at a time. Do a little bit this year, do some more next year, do some more next year, right? The following year, so that it doesn't seem like it's such a bitter pill to swallow. So missing out on low tax brackets is one of the big ones. So
Yeah, I think so. People get distracted too, I think, with wanting a tax refund. If you don't get a that just means you keep your money longer,
Yeah.
So I don't know. I mean, you just have to be like I said, it is a hard thing to look at, but at the same time,
sometimes it cracks me up when clients come in. Well, my neighbor got a refund. Okay. My neighbor drives a Ferrari. I don't have a Ferrari, right? I mean, I mean, just because your neighbor or your barber got a refund doesn't mean, and Tony's saying a refund doesn't necessarily mean, everyone wants to pay the lowest amount of taxes they can, right? I don't care what tax bracket you're in, but a refund generally means you just paid in too much. And then sometimes we get clients who've, if they're elderly, they don't have a lot of income, they didn't pay anything in, right? So they paid nothing, and they're like, how come I didn't get a refund? Like, well, you didn't pay anything in. You generally don't get refunds. A refund means you're getting your own money back, right? So if you don't pay anything in, you can't really expect to get a big refund, except, when we have these little stimulus stuff that's going on. But
what can you tell us about, you're going to be the subject matter expert on this one.
Right.
I know a little bit about probate titling. I mean, we see people make these mistakes. You want to always add a beneficiary first and foremost to anything that you can.
Right.
You add a beneficiary, essentially you bypass probate, but what else, what other mistakes do you see people make?
So the big titling mistake is there's been a million books written around about avoiding probate. It's, it's expensive. It's a bunch of lawyers and we're all making our fees. And look, we want to avoid probate as much as anyone else. But where we see titling issues, and one of the ways to avoid probate is to put somebody else's name on it. So if I put your name on my house and I die, you get my house, you don't have to go through probate, right? Because it's contractually, we had an agreement that you get whoever dies first gets the house.
That I'm getting the Anselmo manor?
Yeah, well, you're in a long list. So, so we won't put a picture of the house, but so the issue is, okay, so Tony, let's say today, instead of doing that, I put your name on the house. If you get in a car accident, my house is at risk that person may sue you for, like, we had a client that happened to. We had a client whose daughter got in a car accident and killed a cardiothoracic surgeon, which
Whoa.
he was about your age, and he was making like $5 million a year. So they're like, well, projected out for 20 more years, that guy,
Oh,
that's a lot of money, right?
wow.
So her little $300,000 Allstate policy isn't going to cover $20 million lawsuit. So if if her name was on her mom's house to avoid the whole probate issue, her mom's going to be on the street, right? So there's issues like that. Anytime you put somebody's name on them, they're an owner, so they can either anything in their life can screw it up. They get divorced, right? Half the marriages end in divorce in this country, so that part of that asset goes to the no good daughter-in-law that you really never liked anyhow. So, titling issues are big. Don't like. There's other ways to do it. Power of attorneys, trusts. Don't put other people's names on your accounts. So I mean,
So the simple way, I think what is basically like, you don't have to go to extreme lengths to avoid probate.
Right. And like, even if you want, a lot of elderly clients, they put their son or daughter's name on their checking account so they can write checks for them and all that kind of stuff. We think it's better either use a trust or just give them a power of attorney. So you give the power of attorney to the bank, say, look, I want them to be a signer on the account, but I don't want them to be an owner. Right. So if the son or daughter gets divorced, gets in a car accident, mom doesn't lose her bank account. So there's better ways to do it. I don't know if people maybe they don't know, or they've, talked to their barber, and the barber said, well, you just put your name on the account. So, talk to a professional, because these titling issues, they really get sticky if there's a death, right? So we've had issues where, now there's 6 people on the account and one of them dies. Who gets that 1/6? I mean, it's just a nightmare. We see that, especially in Ohio with real estate. I don't know if everyone knows this, but if you're married and you own property in Ohio, we believe it or not, we still have this archaic thing called dower rights. Remember when the people used to have dowries? So this was designed 100 years ago, so to protect the women, so the male couldn't sell the house out from under the wife, right? So, but we still have that around. So if I wanted to sell a piece of property, I'm married, even if my wife's name is not on the property, she has to sign off, right? So we've had instances with titling. We can do these transfer on death designations. I don't know some people call them transfer of death deeds. They're not really a deed, but so it says like I own the property together with my wife, and when we're both gone, it goes to our 2 kids. So 2 kids is probably okay, but if you have 4 or 5 kids, then potentially, if they want to sell that house, 4 or 5 kids have to agree, and 4 or 5 spouses have to agree. Like, you can't get 10 people to pick a restaurant, let alone pick, well, I think it's worth 200,000. Well, I think it's worth 210. I'm not selling anything, right? So in that situation, that is not the best way to do it. Look, it avoided probate. Yes, we all agree avoided probate, but you're going to have more of a nightmare than
Creates more headaches than it solves.
I mean, can you imagine getting 10 people to agree on selling a house? It's hard to get the husband and wife to agree to sell the house, right? So I mean, it just creates more of a nightmare. Or if one of those person passes away, so it could happen, if all 5 of them get it, and then they own title 1/5 each. If one of them passes away, who gets that 1/5? Right? It's just a nightmare sometimes. So I just don't do it yourself.
Yeah. Speaking of do it yourself, we talk a lot about self-directing. I honestly don't have, I think there's a place for self-directing your own investments. I don't think there's anything wrong with doing it, even if you're into your retirement and you want to take a small portion of your funds and self-direct. Self-directing just basically means you're managing your own money. You're picking and choosing your own investments. It's become really common nowadays with online trading and apps and things like that. So certainly nothing wrong with it. I think, though, if you're getting into your mid 40s, into your 50s, and certainly beyond that, you're going to want some professional help to make sure that you're not making any mistakes. There are things available too that we do. It's not just, we're not just selling people stocks and bonds and allocating portfolios.
Right. I mean, because when you're young, put this easily. Well, look, you're young, you don't have a lot of money yet, right? So but it's a lot of money to you because it's all your own money. But it's really hard to hire professional help when you have $5,000, right? So once you get a sizable amount, maybe 100,000 or more, maybe you should look at getting some help because like you could. There's so many things that could go wrong. I mean, you buy 10 different mutual funds and they all sound good, but they all buy in the same thing, right? So it's good to be diversified, but as Tony's saying, once you get to a certain level, you really want to get some help. I mean, I look at it like owning a car. Like I could put the windshield washer fluid in and I could probably change the air filter. But other than that,
There you go.
I'm leaving it alone.
Right. And I mean, when you're starting your working career, you just want exposure. You want exposure to growth. You want market. Sometimes we get people in their 20s and 30s in here saying, I'm scared of the market. Well, it's not my place to say, no, you shouldn't be. I mean,
Right.
you really shouldn't be. But, you have to there's risk involved in not being in there too. Do you want your money losing to inflation? Do you want, a 0.5% now until the time you retire? You got to take some risks at some point, but at the same time, you can do that a little bit more methodically.
And most people like us that are RIAs, like you're going to pay them anywhere from probably 1% to 2%, depending on your size of your portfolio, the complexity of your portfolio. But I think, Tony, you mentioned on another show, there's studies that show that it's worth it. I think you had a study.
Yeah, absolutely. The Vanguard of all, people think, Vanguard they do a lot of self-directing. They do a lot of do-it-yourself, but they also support advisors. So Vanguard did a study a couple years ago. A good advisor will add 3 percentage points to your bottom line. So that's 3 extra percentage points of return
after the fee,
after the cost. So their
right?
cost is worth about 3% to you, 3 percentage points.
So even if you paid them 2, you would have been up 5. You net 3.
Right.
So now we're not saying it's always going to be better, but generally, I think what happens, what we see the most is, and I tell people it's like a roller coaster. Like everyone's laughing and giggling on the way up, right? It's when it goes over the hill they start screaming. So your advisor really is there to hold your hand when it's going over the hill.
Help you save you from yourself, really. And then also, as we mentioned earlier, I think part of that value is not necessarily just picking the right stocks or anything like that. It's putting an income plan together, putting a financial plan, a living, breathing document together that we're going to work together on going forward. So if changes happen in your life, we want to make changes to your plan. And that's part of where the value comes from.
And I think the advisor can help take the emotion out of it. Too many people invested emotionally. I mean, even what we opened the show with, people are investing based on their politics. I'm like, well, okay, but people do invest emotionally. So, and then they rationalize why they invested that way. So you really want to take the emotions out. What did the numbers say? What did the analysts say? What's going on in the world? And oftentimes the common layperson isn't privy to all that information, or maybe it's out there. They just don't know how to get it quick enough because things move so fast today. I think it used to be you just wait for the paper and 3 days later you made a stock trade because you read an article 3 days ago. Today it's instantaneous. So
it's very fast.
Yeah.
Yep.
So, our money managers, like a lot of other money managers, are just in a room watching screens all day, keeping their eyes and ears to what's going on politically, what's going on around the world, what's going on, economically. So you're paying for that expertise, and it's worth it. I mean, you had a toothache, you could probably pull your own tooth out.
Oh,
would you? I mean, physically, physically, you could, right? I mean, you could.
Of Tom Hanks.
Yeah, in Castaway.
No way.
So I mean, if you really had to, you probably could. But I think I would say the great majority of people watching this presentation of late, more than 2 of us, would probably go to the dentist, right? So, and you pay for the expertise, and and I have to equate that to, it's like filing your own tax returns. I mean, if I wasn't
How
do what
many
I
of
do, I would
those?
never file my own
Yeah.
tax return.
How many of those have we seen? Did we see last
Oh,
year too?
yeah,
With I did it myself and I messed up, and this is what happened. Not to say that you can't do it.
yeah, and there, I think there was an article in the paper just the other day about, so right now they're going to add a bunch more IRS agents. It's not necessarily all going to be people going after people, but just to process returns. Because when you mail stuff in by hand, it's a whole nother nightmare. I mean, it's just, they showed this picture. Just, yeah, it's almost like, you remember Raiders of the Lost Ark? And
Of course.
at the end of the movie, they rolled the ark into some national archives, and there was a billion other boxes in there. That's kind of like what the IRS processing center is when you mail it in by hand. So, we've been filing electronically probably for 30 some years, as long as it's been around. Yeah, you just don't do it. Don't do it yourself. Don't mail it in.
Let's recap our 6 mistakes that we see clients make and how we help. So we talked about not letting the noise win, especially politics. Just block it out. Don't let it win. We talked about 401k IRA mistakes. If you're looking to take money or do something with it, consult a professional.
Right.
It's not worth it.
Yeah, I think the third one was titling issues. Basically, don't
Yep.
put other people's names on your accounts or your property.
Right. And then we talked about not missing out on low taxes as well. And then self-directing too long or too much of your overall
Yeah,
portfolio.
just like, get professional help. It's worth it. I mean, you get professional help in every other phase of your life. Why wouldn't you do it with your investments?
Yep. So in closing, don't forget to like, comment, and subscribe to us on YouTube and on social media, Facebook. Go to our website or call us to schedule a complimentary consultation if you reference this podcast.
Okay. All right, Tony. We'll look forward to doing this again next week, and hopefully Tony Shore will be with us.
Hopefully he
If
will.
if not, we'll grab Jeff from our office. We got to get him in here in time. So, but we could do this any time of the day, I guess. So, okay, guys. Well, we'll see you next week. Same people know Batman shows. They say same bat time, same bat channel. So, we'll see you here next week. Thanks.
Thanks, everyone.